Good to go.
All right. Good morning, everybody. So today, um, we are going to actually start going over loan programs, various types, what's out there to give you a better idea when you're showing clients or talking to clients what's really available to them, and what are the different loan programs if you don't already know. And we'll go over each one. Today, I think we can touch on as many as we can get to. I'll try to keep it to a half hour. Um, Conventional will really, I think, is a whole nother day. There's so many pieces to conventional financing, whether it be conforming or non-conforming. We're going to focus mainly today on government loans. So with that, you've got VA, FHA, and USDA. Now, with all of those, there are first-time homebuyer programs that piggyback that. So we'll touch on that a little bit as well. Let's talk about VA first and foremost. Can everybody see my screen?
Yes.
Can you guys all see it? Okay. And I think Will sent this out too, so you have your own. But so VA home loans, everybody's familiar with that. We do a ton of VA loans here, being surrounded by Pax River, Andrews, and then over in Virginia as well. There's a lot of people here who commute to DC to for Coast Guard, everything else, even Pentagon. There's a lot of people that live down here for that. So all of those people may have access to a VA loan. There's a lot of intricacies to it, which really over time and experience, you're going to get to know those. The biggest thing about VA is it is backed and insured by Veterans Association. You are allowed to finance 100%. If the borrower is still active duty, most likely they will not have their disability or anything like that yet. They haven't applied for it. So they are charged a funding fee. There is one fee when it's their first use, and then every time they use it after that, they're charged a higher fee. So, and this will vary based on if they put money down or not. You can still do a VA loan and put as much down as you want, depending on your sales price, the borrower, everything else. If they are out of the military and they have applied and receive disability, that funding fee is waived. So that fee is essentially how VA guarantees the loan. Just like mortgage insurance on a conventional loan, somebody has to back it and guarantee it. If there is an issue, the loan goes into default or anything like that. That money is rolled into the loan. So let's say you have a $100,000 sales price. They finance $100,000. Their loan amount will be 102,300, because that funding fee is 2.3% and is financed on top. Okay. So it is not uncommon to see this. Most veterans, I would tell you, finance 100%. Even if they have the option, a lot of people opt to keep the money in their pocket, put it towards repairs or updates or anything like that in a home. There are some cases where people will put down 5%, 10%, even 20%, and then their funding fee is reduced, and it's tiered based on how much they put down. That's something you'll never have to worry about or go over. Biggest thing is in your conversations with them, the disability piece may come up. Just so you know, if a veteran has 100% disability, and believe me, you'll never know. It's not like they're wheelchair bound and, having someone help them around or anything like that. You will never know by looking at someone or talking to them that they have 100% disability. If they do have that, and we can show it, they do not pay, or they are not obligated to pay county real estate taxes. So let's say you buy a $500,000 house, taxes are $450 a month. They do not have to pay that to the county. There is a processing fee the county charges. And we go back and help them with this all the time. I get probably 5 or 6 emails a year from veterans who receive their 100% disability rating and go back to the county and ask to have taxes removed.
I'm sorry, Darren. Are you talking about property taxes?
Yes.
Okay.
Yep. So they do charge like a $30 or $100 processing fee, and that's something that's still there. They can actually escrow it or just pay it themselves. But that is a huge benefit to veterans. It is something to know when you're talking with a veteran. They may give that information out readily, or it's something I find out. I pull their eligibility from VA. It's called a certificate of eligibility. That tells me whether or not they've used their VA before, or if they have disability. And it'll tell me, won't tell me the specific rating, but if they are 100%, it will tell me that. Okay.
Hey, Dan.
Yes.
Good morning to you, bud. Hey, so in the beginning, you were speaking of, it was backed insured and funding fees, first use and second use after that. I know that when I've run into opportunities with VA, it's always, I'm pretty sure I talked with you about it once before, I think. How many times can they use this, or what is that breakdown? I think that's some good information.
I was actually just going to go into that piece next.
Okay. Thank you, sir.
Yeah, no problem. You can actually use your VA loan or eligibility as many times as you want. Borrowers can buy 5, 6, 7 houses throughout their life. They can actually have I've never seen anybody be able to do it with 3 houses, but multiple houses they can have at one time. In other words, let's say we get a lot of people moving to PACs who are pilots moving from California. They have a house in California they want to buy here. They can actually use their eligibility again if they have enough left over. Sometimes it requires a little bit of a down payment. But with the lending limits where they are now, the eligibility a lot of times allows them to buy 2 houses at once. It is a calculation. There's nothing you're going to be able to tell them right off without having your eligibility, without doing the numbers, everything else. It depends on whether they're buying in Calvert, whether they're buying in St. Mary's. It depends on how much of their eligibility is left over. In other words, how much of a house did they buy somewhere else? Was it a $200,000 house or was it an $800,000 house? All of those factors go into determining how much of their loan can be used again. They also, let's say they can buy a house up to $200,000. That's what VA will insure and finance 100%. They can put $50,000 down or a percentage and still buy a $300,000 house. They just can't use their VA loan for 100% of it. Does that make sense? In other words, they used their VA loan and bought a house at 100% and financed 100% of it. They can now buy another house, keeping that one, not refinancing it, not selling it. They can use their VA eligibility to buy another one, but they may not be able to finance 100% of it. They may have to put 5% down, 10%. And that's something I would tell them. That's something I calculate based on what they're looking for in the area.
Gotcha. Okay.
Darren, can I ask you a question?
Sure.
I was just talking to a client about this yesterday, and I'm sorry, I'm in the car on the way. We're going skiing. So I have some kid noise. But I was just talking to a client about this yesterday, actually, as there was someone who was contacted them about doing an off-market deal to purchase their townhome. They're looking to sell next year and to buy a single-family home that's quite a bit larger. And that person wanted to assume their VA loan. And they had already spoken to a lender before working with me that said that they would be eligible for an extension of their VA loan if they even kept the townhouse as a rental. And they were asking me about that, and I didn't quite have an eloquent answer, but it sounds like, and I just tuned in, so I'm sorry if you've already touched more on that, but
yeah, the assumption
tell me why
is
that
a whole different piece. So with that, it's not really an investment property. The assumption, when someone assumes it, I'm assuming the person that's going to do the assumption is not a veteran. That means the veteran's eligibility stays with that house until it is sold or someone as a veteran replaces theirs.
That was my understanding as well. So for them to keep their eligibility and this person to assume their loan, this person would have to have VA eligibility as well. Is that correct?
You can assume it and not be a veteran if the bank allows you. I think that new person still has to pay some sort of funding fee.
Okay.
Even if you're not a veteran, they pay a partial funding fee. I know very little about this because assumptions are handled internally by the bank that holds the loan.
Gotcha.
It's not done by us. There's no lender that can do assumptions. You have to be approved. The buyer has to be approved, and the seller has to be approved by the bank holding the loan. In other words,
they make me weary because when I first got my license, there was an agent at my brokerage that worked with their client on an assumption, and then it turned out afterward that the seller was no longer eligible to use their VA anymore, and the agent didn't tell them of that, and it was just, you can imagine how awful that was for everyone involved. But
technically you should be able to treat it just like a normal, let's say you kept that house in your name as an investment property, moved on, you could use your VA to buy another one. You just don't know how much of it you'd be able to finance 100%. But I would definitely, I can try and reach out and get an answer, but the best way to do it is for the veteran to actually call VA and say, and ask them and say, if someone were to assume my loan and the eligibility stayed there, can I still go and use the remaining portion of my eligibility to buy another house?
Okay.
Because it's a very different scenario. It's one that you don't deal with every day in the market. So I would definitely get the blessing of VA theirself to the veteran. And that's the only way you're going to know 100%.
And
Thank you.
It doesn't matter if a VA person assumes a VA loan, then the eligibility just carries on, right?
Well, they swap them out. So if a veteran assumes another veteran's loan, the eligibilities are exchanged.
Right. Okay.
So it's just like at that point, it's just like the veteran selling, his full eligibility is restored, and then they can go buy somewhere else. I don't know why anybody would want to let a non-veteran assume their loan, because if something were to happen, your eligibility is tainted. Does that make sense?
Right. Yeah, absolutely.
It's like FHA or any loan. If it goes to foreclosure, that stays as a CAVERS or a federal obligation or debt. And you're not going to do another FHA loan. And typically there's a balance due that you owe HUD. So I'm not sure why anybody would even consider that. In other words, why a veteran would consider, unless it's a family member or somebody that, you know what I mean?
Yeah, it just seems like they had asked me about it, and I said, I need to get more information for you, but it doesn't seem like there's any benefit to you letting this person assume your VA loan. There's no benefit to you whatsoever. So,
and I would almost guarantee you that the person looking to assume doesn't understand what it means. In other words, if that
I think they
person has
just see
$300,000
that low
in equity,
rate that they locked in, and they're wanting that, but it's not beneficial for the seller.
It is not. It is, especially in that situation. So that's the hard part. All right. So where were we? VA, multiple use. You can use it over and over and over again. I have multiple clients here that have multiple properties, both with VA on it. You cannot leave a house. Let's say you want to buy it, you buy in St. Mary's, then you want to buy another house in St. Mary's or VA. You have to be a certain distance away. You have to have a documentable reason why you're buying again in the same area, meaning just got married, now have instant family of 5 instead of just myself. Perfect reason, they'll allow it. Moving closer to work, I changed jobs and now I'm moving closer. Perfect example. Those things are all things we need as a lender to approve a loan in the same area using your VA a second time.
Does it matter if they then use that original property as a rental property or no?
No, does not.
Okay, good to know.
Same as FHA, and we'll get into FHA, but now that we're talking about it, same exact thing. You cannot use FHA twice.
Yeah.
In other words, you can't keep your current FHA house, turn it into a rental, and buy another one with FHA unless it's, I think theirs is 50 miles apart, and then you have to have a good reason.
Okay. And
they literally will look at appraisals and SStat and go, okay, this is a 3-bedroom house. You're going to buy in a 2. That doesn't make any sense.
Yeah.
It has to be something that makes sense. Okay. All right. So everybody's clear on VA. I mean, again, this is probably one of the most popular loans in this area. If you're dealing with a lot of people on base or people who are transferring in, it's one of the first questions I ask almost every single client. You know, are you a veteran? Do you have access to a VA loan? You know, it's super important to know that, because my qualifying documents I ask for, everything are different. And it's important. That's a great thing that comes up in conversation with you guys. You know, if you have somebody transferring in, that's one of the things you're going to ask, you know, because you need to know, one, they're a veteran, and two, if they're still military and coming in, they get BAH, which is their housing allowance. 9 times out of 10, that buyer is going to want their mortgage payment to be equal or less than their BAH. It's just how they look at things and what they want. That's their money being given to them to pay for room and board or housing. That's their goal, is to be within those parameters. So you don't have to know that specifically what the number is, but it's good when you're sending somebody to me and you say, hey, I know they're a veteran, they're active duty, they're moving here in July. They all have a date where they have to report. So that's important to know as well. We don't have a lot of Navy like you do in Norfolk, where people were on a ship. You'll get some transferring every now and then where the husband or the wife is on a ship and will not be here, but the family's coming in. So you may be showing houses to a wife and kids or a husband, and the other party's not around. So that's a great question, or something to pass along as well. Okay, FHA. We touched on it a little bit, but FHA is a government loan backed by HUD, Federal Housing Administration. They insure and back the loan with a upfront funding fee, which is just like VA, except it can't be waived. And they have monthly mortgage insurance. So 1.75% upfront, lower than VA. It's financed, but then they tack on a monthly mortgage insurance premium, which you cannot get rid of unless you put money down into a 15-year. It never goes away unless you refinance. Okay. The good thing about an FHA loan, one, they have a rehab portion to the loan. So you can buy a house that's dilapidated, roll in costs to repair, and purchase the house all at once and then fix it up. They also allow for, or have a tolerance for, lower credit scores. I can get loans approved all the way down to 580. You can put as much down on an FHA loan as you want. I've had people with 620 credit scores put 20% down because I couldn't get conventional approved. So FHA is their only option, but they still want to put the money down to lower the payments. FHA, because it's a government loan, they require a 3.5% down payment for this purpose. You can, like I said, put as much as you want, but 3.5 is the minimum. 5% or more, your monthly mortgage insurance gets reduced. So it's lower amount. They do offer a FHA streamline. So this is a great option for those who go into an FHA loan and then we get into a refi situation. Credit hasn't improved. We can streamline their FHA into a lower rate, basically no appraisal, no income qualifying, just like VA. And we can go to a lower interest rate on the loan. That's all on my side, but it's something good to know if you're talking with clients and kind of the benefits or ins and outs of FHA. A lot of people, and I'm not sure where they get it from, just marketing or ads, but they will come to me and go, okay, well, I want to do an FHA loan. And they don't bring up anything else. They just know they have to do an FHA. They think it's the lowest down payment out there. They think it is the best loan by far for any option. And in some cases, they are correct. It's easier to get a borrower approved with high ratios. In other words, our ratios that we look at are your housing and total debt ratio. Your housing ratio is the front ratio. We take The monthly payment divided by your gross monthly income, that's your front or housing ratio. Back ratio or total debt is all of your debts, car payment, credit cards, student loans, what have you, plus the house payment divided by your gross monthly income. That's what we look at for qualifying purposes. VA and FHA both, I've gotten loans approved over 55% total debt ratio, meaning all their debts plus the house payment is using up over 55% of their gross income. So if you think about it, after taxes come out and everything else, you're not left with a lot of money every month. So that's huge to be able to do a loan for someone like that. Typically, you've got other income we're not counting, like a wife or something like that. There's extenuating circumstances, or the person's got a lot of reserves, meaning money in the bank, to get a loan like that approved. That's where the easy credit qualifying, things like that come from that you'll see. So that's one of the big benefits of an FHA loan. Now, appraisals are different for FHA than anything else. In other words, an FHA appraisal has different pages on it, different requirements, everything else. And that's on the appraiser side. You know, VA and FHA both, everybody really worries, well, it's a VA appraisal. It's going to be terrible. This house isn't going to pass. It's typical of every loan, health and safety issues. I just did an FHA loan for a borrower. They had a 580 credit score. It was an as-is sale. Appraisal flew through, no problem. The appraiser did it as FHA and noted it as is. So a lot of the things didn't come up that were an issue. I think there was a smoke detector that wasn't in the room, so we had to bring it up to code. It had to be a new smoke detector put in and take a picture of it, and that was it. Some of the things you'll see on both of those, decks are probably the biggest thing, and steps. If there's pickets missing or railings busted or falling apart, boards are missing. Steps going into a house is some of the things I've seen that don't have railings. If it's code, they're most likely going to hit it because it's, again, health and safety issue. Doors going out to a deck area where there's no deck, want to make sure they're secured. They have to have the plate in it screwed in so kid can't come along and open it by accident. And that's another thing you'll see. But other than that, they are not harsher on these loans than others. Okay. Any questions about that? Nope. All right. So we'll move on to USDA, last of the government loans. So just as it shows, backed by U.S. Department of Agriculture. So this loan is secured or insured by them. They do the same thing. They charge a upfront fee. Theirs is 2.15%. That is allowed to be rolled in. So $100,000 loan or sales price would be $102,000 loan amount. And then they have a minimal mortgage insurance. It's a little bit more than half of what FHA is. So is a better option. I will tell you, if you put a USDA loan side by side with a 97% or 3% down conventional loan, MI, everything, the payments are going to be within $20 to $30 of each other. It's very, very comparable. USDA has income requirements. So every county, based on your household income. So if you have 16-year-olds, they're going to have the borrowers document that they are not working. So they look at tax returns, they look at all the household income. Mother-in-law is going to move in, or we can count that as someone in the house. If they're not working, great. It increases the income limit sometimes. So 3 people and above, so 1 to 3 or 3 and above. For some income limits, USDA is actually 5. So when you get above 5 people in a household, you have a higher income limit. Okay. Income limits are fairly large now. Used to be very moderate. It was easy for someone not to qualify for this program because they made too much money, especially if you had 2 people and they were working, both were working. Now, not so much. Calvert, I believe, is 190s. So it's very, very easy to qualify for this program. 100% financing is fantastic because, especially in this market, you're financing as much of the loan as you can, and the borrower's money is left over for closing costs. Everybody knows this loan. It probably, I wouldn't say percentages, but probably 50% of what we do is a rural development loan, especially for first-time home buyers. A great option for them to get into a house. Rates are super, super low. Typically, if I'm sending out rate sheets, USDA is the lowest interest rate that you'll see of any program. For instance, today you're probably at 6.25, 6.375, whereas FHA is 6.75, 6.875. And it stays like that. There is a break between the two. So USDA, some of the better rates, some of the cheapest or easiest to finance. Again, appraisals, same thing, health and safety issues. That's the biggest thing. USDA has gone back and forth on a couple things. One is acreage. Typically, you can't have over 5 acres. If you do, it has to be similar comps in the area. In other words, some of these communities that have 6, 7 acres per house, there are a few in St. Mary's. Or surrounding area, most of the houses, it's a rural, very rural area, and they all have the same acreage. We can do that, but general rule is 5 acres. You know, if you're in Prince Frederick and outlying and you're buying something and it's 8 acres, that's going to be an outlier. It's probably going to be hard to get comps that are all 8 acres or above. But St. Mary's, we do see that quite a bit. Multi-unit, not multi-unit, but 2 units, meaning an in-law suite. This is something they go back and forth on. Has changed a lot over the years. Used to be no problem, then it went away. You can't do it. Now you can have an in-law suite with USDA, but it has to be attached. In other words, you cannot have an in-law suite over a detached garage and do a USDA loan. So you'd have to take out the kitchen and just make it an office, then you're fine. If you have the basement and there's an in-law suite with a separate kitchen and unit, everything downstairs, that will fly with USDA now. So keep that in mind. There's quite a few of those. The large tract properties, 8, 5, 6, 7, 8 acres, and they've got a accessory dwelling in the back, will not go. Okay. Refinancing, again, government-backed loan, streamlined refinance, no appraisal, no income qualifying, simple. They just require that you have at least a 1% difference in your rate. And then it's simple and easy to do. Okay. That's pretty much it for government loans. Now, all of these guidelines are set by the entity, USDA, HUD, VA. You will see a ton of guidelines online and people will come to you and go, no, I can do this, I can do that. The banks are the ones giving money. So they have what we call overlays. Even though there's guidelines established by the government entity, the banks basically come in and say, great, we want to make sure the person has such and such income, has worked for 2 years, you know, all of the stuff we do for other loans. You will see online people come in and go, yep, I'm going to use my VA for construction. There is a VA construction loan. Not many banks do it because, again, think about it. Who's going to finance 100% on new construction, especially now with the cost influxes, change orders, everything else? It's very, very difficult. USDA has a construction loan. Again, not many banks participate or offer it. So your clients may come to you with all these crazy things and you've never heard of. Just listen, give me a call and ask about it, and I'll let you know. One of the big things you'll see out there right now, everybody's calling, and you guys have probably gotten a call from a lender at some point that said, hey, love to get together with you. I've got a great 100% financing FHA loan. In other words, we'll do FHA with 100%. It's a play on words. It is an FHA loan with a grant program. They're giving the borrower a 4% grant rates are 1% higher, and you must have a 660 credit score for the grant. So be careful of the ones that you're getting bombarded, or you know, it's almost that too good to be true. There's lots of things out there that people will throw at you, and just to one, get a deal, or two, get their foot in the door. So it typically, I will tell every borrower, if something's sounds too good to be true, just like your parents used to tell you, send it to me, let me look at it, and I'll tell you for sure. I had a past client call me yesterday, wanted to refi. It was last week. He calls me the other day. He goes, "Hey, I need to get a mortgage statement." Like, well, we kind of talked about this. You're going to refi when rates come down. He goes, yeah, I found somebody. We're moving forward. He found some online lender. It was 5.25 with no points. And I said, you've got to send me your paperwork. Like, if that's true, I will be the first one to tell you it's a great deal. You need to move forward right now. And he sent it to me. It was 1 point, and it was locked at 5.25. Some broker out of California. I have no idea who it is. Never heard of it. But it's one of those deals you can't pass up. And I told him, I said, here's your mortgage statement. I'm like, good luck. I hope it works out. Just no one around here will beat that. Not even match it. Navy Fed, nobody. So not sure what that person's doing, but you know, they found a good option. Most of the time you're going to find stuff like that 1, 2, 3 points, because VA allows banks to charge the veteran as many points as they want, or up to 3 points on a VA IRRRL. So they could be just diminishing their equity in these refinances. So that beside the point was a lot of these programs have spin-offs of it. So if you hear of something like that and you don't know what it is, just call me. I'm happy to go over it with you, see what I can find out if I don't know about it, you know, and get some answers. Okay. And that's government loans right at a half hour. Look at that. Anybody have any questions about any of these? No?
I don't. I learned a lot today, though.
One thing to keep in mind, first-time homebuyer programs, like the program through state of Maryland, that's why I scrolled back up. Maryland Mortgage Program really has 2 overlays, a credit score and a debt ratio. And we can kind of get away with around some of that with waivers, but they are an umbrella. They use all the guidelines like I just went over with you, VA, FHA, USDA. When I tell somebody, yeah, with first-time homebuyer program, I'm not straying from any of those options. They're either going to do a conventional loan, a VA loan, FHA, or USDA with the umbrella of the Maryland Mortgage Program, which gives them lower rates, down payment assistance, everything else. We're still using the guidelines, the appraisal, everything for these other types of loans. So that's how the Maryland Mortgage Program and some of these others work. Okay. But on that kind of wraps up government stuff. Next time we'll go into conventional, just because there's a lot of programs within conventional, a lot of new information, especially like the one I sent out yesterday, which is a grant program we're offering for conventional homeowners or conventional people, those who want to finance. Okay.
I'm sorry, I missed something. Is there any PMI with the USDA?
Yes, there is a upfront fee, which
Yeah.
can be financed. It's rolled in, and then there is a monthly mortgage insurance.
Okay.
So very similar. They all work the same way. They're very, very similar in their structure. They're just different price points. In other words, different costs associated with them. All the government loans. VA is the only one that will waive it, and they waive it for their veterans who have disability, which is huge. There are a lot of times where I will compare for a first-time home buyer. I will compare, if they're veteran, compare VA to USDA side by side. A lot of times I will tell them USDA is the best option for them at first because it's a starter home. It's not their forever home. The funding fee on a second use is much, much more. So we're not sure if they're going to have disability. Why not leave your VA for your next purchase? Use USDA. They're very similar in nature. And payment-wise, they're very close. So we use USDA first. Then when they come back, they can either keep that as a rental property, sell it, and then use their VA on the higher priced forever home or second home they buy, family home. So that's something to think about if you're dealing with veterans as well. They have multiple options, not just VA. All right. All right, guys. Well, you guys have a wonderful weekend. If you have any questions or something comes up with somebody, let me know. I'm happy to go over all of that.
Awesome. Thank you so much, Darren.
All right. Esther, you just want to call me?
Yes, whatever is best. I can call you.
Okay, just give me a call. I'm sitting here in the office.
All right, thank you.
All right. Bye-bye.
Bye, buddy.